All right, greetings. Thank you for being here. Couple things real quick before we go over the homework is to reiterate, I spend more time on those first two chapters than most instructors. We had 10 lectures, didn't we? And then you took the test. One thing I wanted to point out is I don't want you to think I don't want you to get used to that timing. We're not going to have 10 more lectures before the next test, okay? The time period now before your next test will be not as great as the first go around. Does that make sense? But you know, your syllabus states when we're going to have tests over, you know, when not, let me back up. Your syllabus states what chapters are on what test. So you can kind of get a feel for when the test is coming up. I will let you know chapter 4 is pretty short, okay? So this test number 2 over chapters 3 and 4 will come up a lot quicker than the first one did. Cool? All right?
Will test 2 be over information from, I mean, I know they build on each other, but it'll be most specifically about 3 and 4.
Yeah. We'll talk more about that later, and I probably will give you on this next test a little bit of a review sheet. But there are some things that I will ask. Like I like to ask what financial statement accounts are on. I like to ask you, how do you affect the change in that account? Like, how do you decrease accounts payable? Those sort of things, because I really want you to keep that going. But it's not going to be totally comprehensive. But you're right, it builds on itself. So, all right, I want to go over the homework. Before we do that, I'm going to go through a few slides here, just as kind of a refresher of what we talked about last class period. Last class period, we begun adjusting journal entries, and this can be a more difficult section for some people. If you need, this is the great thing about this class, is for you face-to-facers or you folks at home, if you need to rewatch these lectures, you can rewatch these lectures, okay? If you think I'm great and entertaining the first time, you should see me the second time, okay? All right? So, let's go to the slides right now. We talked about how we do not use the cash basis of accounting because it's not generally accepted accounting principle. We use the accrual basis of accounting. The accrual basis of accounting, things aren't hinged on when cash comes in or goes out. We recognize revenues when they're earned. When they're earned, when the product or service has been provided. And we want to recognize expenses when they are incurred. Okay, we went through some examples. We talked through the revenue recognition principle. I just went through that. The matching principle states that we should attempt to match the expenses to the same time periods in which they helped create revenue, right? We talked about an adjusting journal entry. And it is a type of journal entry that's recorded to bring an asset or liability account to its proper amount and to recognize a revenue or an expense, okay? We talked about AJEs are always made on the last day of the period, okay? Some companies do financial statements every month, and thus they make AJEs on the last day of the month. Some companies just do annual financial statements, and thus they just do AJEs on the last day of the year. The cash account will never be part of an adjusting journal entry, all right? And then we talked about the 5 types of journal entries. One other thing that we talked about to switch over to the ELMO is that every AJE okay, every AJE will affect a revenue or expense. Excuse me. Edit that out, okay, Dane? All right. Every AJE will affect a revenue or an expense and an asset and a liability. One from this side and one from that side. Remember that? And we talked about how every AJE is either going to credit a revenue account or it's going to debit an expense account. Okay? Now, did that kind of help you as you were doing your homework, some of those rules? Okay, I want to go through that homework. I did not give you any book homework. Instead, I wanted you to work through these worksheets I gave you, okay? Which you folks at home can find on Angel under the Lessons tab for the appropriate chapter. So, let's take a look at the prepaid assets AJE worksheet, okay? And let's just look through the first one a little longer than the others, okay? All right, the prepaid insurance account has a $4,700 debit balance before adjustments. An examination of insurance policies shows that $900 of unexpired insurance is remaining, okay? Now, they tell us the beginning balance and they tell us how much is remaining. We need to figure out how much was used up. How much of the asset was used up and thus needs to be recorded? $3,800, right? And thus the AJE is there circled in yellow. Okay? Does that make sense? Kara?
Where do you want us to put the date, or do you want us to
Oh, if you put the date, you can just put it over here to the left.
Okay.
Okay? Now I want you to contrast that with the next one I ask. Company B, and this is totally separate from Company A, okay? Company B, the prepaid insurance account, has a $5,890 debit balance before adjustment. An examination of insurance policy shows that $1,040 of insurance has expired. Do you see the different wording there? I'm not telling you the ending balance. I'm telling you how much has expired. So, how much of the asset was used up and thus needs to be expensed? $1,040, and that's your JE. Now, I'm not trying to trick you. I'm just saying that in the real world, people are going to come at you with questions with different wordings, right? And I want you to understand the concepts so that you can deal with that accordingly. Okay? We always want to know how much of the asset was used up. Company C. On September 1, 2011, when we prepaid $24,000 for 2 years of rent, we debited prepaid rent and credited cash. Okay? Now, of course, that's not an AJE. That was just a journal entry, right? Now, how much of the asset was used up? Now, here we got to kind of figure out this a little bit. They paid $24,000 for 2 years of rent, right? And how many months is 2 years? 24 months, right? So basically, what are they paying per month? Okay, so on September 1st, they gave us $24,000 for 2 years of rent, which is 24 times 1,000. At December 31st of 2011, how many months have we provided them occupancy? 4, right? So 4 times 1,000 is 4,000. That's how we come up with that amount. Does that make sense? Or there's other ways you could have said it. You could have said it's $12,000 a year, and we provided occupancy for 1/3 of a year, which is 4,000. But I want you to understand how we get that 4,000. Okay, any questions on that first worksheet? If not, let's go to the second worksheet, which was on office supplies AJEs. Okay? All right. The office supplies account had a $300 debit balance on December 31st, 2010. No office supplies were purchased during the year. The December 31, 2011 physical count showed 110 of supplies available. How much of the asset was used up and thus needs to be expensed? Did you get 190? Okay. And if you want, you can do a little AJ or a little T account. We had 300 to begin with. We didn't purchase any, so I put 0 there. And then they gave us the ending amount of 110, right? So how much was used up? Said another way, you could say a restaurant had 300 bottles of beer in its refrigerator. At the end of the night, they counted only 110 bottles remaining. So how many bottles of beer did they sell during that day? 190, right? So we want to know how much was used up. It needs to be expensed. And this is the journal entry. Debit supplies expense, credit office supplies. Make sense? Same situation for company E. They tell us that we started out with $800. We purchased $2,100 during the period. And then we did an inventory count. We found $650 remaining. Thus, we've used up $2,250. Cool? Last situation on this worksheet, company F. We started with a $4,000 balance. During 2011, they purchased office supplies for $9,400, and that was added to the office supplies account. The inventory supplies available totaled $2,660. Thus, we used up $10,740, right? And thus, that is our journal entry, or adjusting journal entry, more specifically. Cool? Questions on that? Okay, let's go to the depreciation adjusting journal entries worksheet. Okay? We started talking about depreciation last time. Okay, the first one's pretty easy, isn't it? The company needs to record $13,500 of depreciation expense for the year. What amount needs to be recorded as depreciation expense for the year? $13,500, right? I wanted to make the first one easy. Now, the journal entry is we debit depreciation expense and we credit this new account called accumulated depreciation. I remember as a student, when I learned this, I remember the initials were D-E-A-D, right? Dead, right? I still remember that 20 years later. What type of account is accumulated depreciation? Contra asset. What type of balance does it have? What's its normal balance? A credit balance. What financial statement does it go on? Where do assets go? Balance sheet. Contra assets go on the balance sheet too. Now, this is where you might want to add a flashcard if you used your flashcards. How many people have not yet made their flashcards but they're going to? Don't raise your hands, okay? I'll be angry at you, all right? If you haven't made them by now, you'll never make it, okay? But for those of you who have your flashcards, this is a good chance to add one, okay? Because I like to add that stuff on a test, or ask that stuff on a test, okay? All right. Let's go to the next one. Company has one fixed asset. They purchased it on January 1, 2011. The asset had a cost of $44,000, an estimated life of 5 years. Salvage value is estimated to be 0 at the end of the 5 years. So we figure out how much depreciation by taking the cost. Let me scoot this over a little bit. We take the cost minus the residual or salvage value of 0 divided by the estimated life of 5 years. That's $8,800 per year, right? And I told you at the top of here that they only do AJEs annually, right? So our journal entry is this right here. Cool? All right. Last one. Company has only one fixed asset. They purchased it on January the 2nd of 2011. The asset had a cost of $32,000 and an estimated life of 7 years. Salvage value is estimated to be $4,000 at the end of the 7 years. Does it matter that we purchased it on January 2nd? No. Okay? Just round. Round to how many months. Okay? So the cost was $32,000. The salvage value was $4,000. Estimated life 7 years. $4,000 per year. You with me? Okay, any questions on that? Now, let me ask you a question. When we, on that last AJE, let's go back to it. Go back to the Elmo if you would. After, this is the journal entry we made at December 31st of 2011, right? Are we saying thus the market value has declined by $4,000 in that first year? No, we are not. Once again, to reiterate, depreciation entries are not made to try to write things down to reflect their market value. Okay? That's not why we do depreciation. We do depreciation to spread the expense over a reasonable amount of time. Okay? You with me? Now, let's talk about why we use a contra account instead of crediting or decreasing the equipment account or whatever. Okay? All right. I want you to understand it's a little different with fixed assets, long-term assets. Okay? Let's take a look at the second depreciation entry that we made on that. Company H. Okay? Now, they had one fixed asset. They purchased it in January 1 of 2011. Had a cost of $44,000, estimated life of 5 years, a zero salvage value was estimated. So we make this adjusting journal entry, right? And we're going to make that at December 31st, 2012, December 31st, 2013, December 31st, 2014, and 2015. Would you agree? And the way that that's going to look on the balance sheet, let's remind ourselves. Let's do a partial balance sheet at 12/31/11. Cool? You're going to have, let's just say it's equipment. Equipment and its cost is what? $44,000? And then we're going to say less that contra asset of accumulated depreciation, which is at this point is $8,800. And that gives you what we call the book value. 44,000 minus 8,800 is, it's really early in the morning. I think it's 35.2. Is that right? 35.2? Somebody verify that, please. Huh?
No,
Just
you're
somebody
wrong.
bang that out real quick. I think it's 35.2.
Yeah.
Is it 35.2?
Yeah.
35 too.
Matt was up here shaking his
I
head
thought it was
no.
88,000. That's wrong.
Hey, never question me, especially on camera, okay? I'm just kidding. I'm kidding. Is it 35,200?
Yes.
Okay. Now, do you see where we're going to make this entry again at 12/31/12, and this is now, then that's going to be 2 times 8,800, which is 17.6, I think, right? Pretty soon, do you see at 12/31/15, that will be 44,000? Do you see that? What will that look like on the balance sheet at 12/31/15? Well, it's going to be equipment of 44,000, less accumulated depreciation of 44,000. And that's going to be 0, isn't it? Do you see that? And that is the way it will look on the balance sheet for the company. It'll say equipment of 44,000 less accumulated depreciation of 44,000 equals the book value of 0. Now here's why we use a contra asset. If we decreased the asset itself and did not use a contra account, then on the BS or the balance sheet at 12/31/15, it would just say this: equipment, 0. Don't you think that this, knowing that this is what's going to show up, isn't that a lot more informative for the reader? You see what I'm saying? Okay? This is the library building that you guys are sitting in, right? This is one of the oldest buildings on campus. It is fully depreciated, okay? It is fully depreciated. That means it's probably on our books at like, I don't know how much it costs to make, $15 million. Less accumulated depreciation, $15 million. Book value, 0. Does that mean that this building is worth 0? Could you go offer the Board of Trustees and Dr. Calloway $10 and they jump at the offer? No, we're not trying to, we don't depreciate to market value. because everybody's view of what market value is totally different. Are you with me? It's totally different. By us using because fixed assets are a little different than prepaid assets and office supplies, okay? Because we didn't use contra assets there, did we? But when you have an insurance policy that goes for 6 months, at the very end of that 6 months, what is that insurance policy worth? It is worth zero. It is worth nothing, right? It's kind of like your Best Buy card. If you have a $500 Best Buy gift card that you get for Christmas or whatever, when you've used up that $500, what is that card worth? Nothing, and you throw it away. It is worthless. Same thing, if you do office supplies, and if they're all gone, then they're all gone. It's zero. However, if I have a vehicle, going back to the Elmo, if I have a vehicle that I paid $44,000 on January 1 of 2011, and December 31st of 2015 rolls around, it's fully depreciated. Is that vehicle worth nothing? No. Now, we're not trying to reflect market value on balance sheet. But this lets the reader know, hey, we have a piece of equipment that we paid $44,000. It's fully depreciated, but we still have that piece of equipment. Does that make sense, guys? It helps the reader know that we have a piece of equipment. It's fully depreciated, the book value is zero, but we do have that equipment. And we'll keep using it, right? I drove a car to work today that's 19 years old, older than some of you. And if I was a business, that thing has been fully depreciated and has a book value of zero, but does it still have value to Dave Krug? Yes, it is a sweet ride, baby. And I drive that to work, and if something happened to it, I'd have to go buy a new car. I'd be bummed, right? So that is why we use a contra asset account. Do you understand? Questions on that? Once again, I'll emphasize, lay people who haven't been lucky enough to take accounting classes don't understand this. Balance sheets are not meant to reflect assets at market value, because that's just simply too subjective. You with me? Okay, good. All right. Okay, we have gone through all of the homework, have we not? Any questions on that? Okay. Okay, there are 5 types of adjusting journal entries, going back to these slides. And we have gone through Category 1 and Category 2, right? Well, Categories 3, 4, and 5, we go a lot quicker, okay? So let's talk about those last 3 categories, all right? So we went through this, we went through this, went through that, went through that, went through that, a little review here. Okay, now let's go to this one. Adjusting for unearned revenue. And we've actually kind of already done this analysis. This is when we discuss that we sometimes receive money in advance of providing the product or services. And we have to record it as unearned revenue. And what type of account is unearned revenue? It's a liability. Well, what happens is we provide those services. Then we earn that revenue. We decrease that liability. Let's look at an example. On October 1, 2011, Ox University sold 1,000 season tickets to its 20 home basketball games for $100 each. Now, they made the following entry when they recorded this. This is not the AJE. We know that because it's not the last day of the period and there's cash involved. But when they got that $100 times 1,000, they got cash of $100,000 and they credited unearned revenue, which is a liability. Are you with me? Now, it's the year end and they have played 8 of those 20 regular home games. So what percentage of that money have they earned? What is 8 divided by 20? It's 40%, isn't it? Isn't 8 divided by 20 40%? Yeah, it is. So what is 40% of 100,000? It's 40,000. They can thus reduce or debit that unearned revenue by 40,000 and book it as revenue. Understand? Do you see how at this point in your learning, how if you don't know your normal account balances, you got a rough road, don't you? Because let's look at that journal entry again. What I'm basically asking you is, how do we decrease unearned revenue? We debit it. How do we increase basketball revenue? We credit it, right? Do you see why that's $40,000 though? Because we have satisfied 8/20 or 40% of that $100,000 commitment. Okay? Questions? Let's go to a next category. This is accrued expenses. These last two categories, the cash occurs after we make the adjusting journal entries. This is costs that are incurred in a period, but we haven't recorded them and we haven't paid them. Let's look at an example. It's best illustrated with an example. Let's say we pay Barton Inc. Company pays its employees every Friday. Now, year end, 12/31/11, it falls on a Wednesday. As of 12/31/11, the employees have earned salaries of $47,250 for Monday through Wednesday of that week. Okay? Now, we're not going to pay them until Friday, January 2, 2012. We're not paying them early. But at 12/31/11, do we owe them some money? Yes, we do. And do you see how for a company like Sprint, this could be a big, big amount of money, couldn't it? So even though we do not have to pay them on 12/31/11, and even though we're not going to pay them on 12/31/11, we need to show an adjusting journal entry so that we properly get that liability of $47,250 on our books. And we need to book that expense in the proper period. If we don't make this adjusting journal entry, then our liabilities are understated and our expenses are understated. Thus, our net income is overstated. This is a pretty big chunk of money, isn't it? This is one of the main adjusting journal entries when I go in and consult with a client that I make sure that they're making, or else their financial statements are distorted. So at 12/31/11, this company owes $47,250, and even though they don't have to pay it, they have to reflect that liability on the books and they have to book it as an expense. They have to match it to 2011. Make sense? Sometimes you'll see this with interest too. You'll say a company owes interest of this amount at year end, and so you would debit interest expense and credit interest payable. Even though they don't have to pay it, you have to show the liability and the expense. Cool? Last category, this is accrued revenues. This is the opposite. This is when we've earned revenues. We're not going to receive it early, but we need to at least book it. Let's look at an example. Smith & Jones CPAs had 31,200 of work completed at December 31, 2011. Now, we haven't billed them, but we need to make an adjusting entry necessary on December 31, 11 to reflect that we have an asset of accounts receivable on the books. Okay? And we have revenue that we want to match to 2011 because that's when we earned it. So this is the journal entry. This is the adjusting journal entry that we would make. Does that make sense? Okay, that's the 5 categories. And what I want to do now is I want to take some time, switching over to the Elmo, and I'm going to give you 3 new worksheets. Okay? One is for unearned revenue, one is for accrued expense, and one is for accrued revenues. Okay? For you folks at home, again, these are on your lessons tab under handouts. Okay? So we have 3 worksheets. Again, we have 3 key questions and 3 AJEs. You analyze each situation separately, but we're going to spend some time working on those in class right now. Okay? So let's roll the music. I'll hand those out, and let's go ahead and work on those together. You folks at home, you do the same, okay? Okay, folks, we're going to come up here before class is over. I don't expect that you're done, but what we're going to do is this, and I'm going to say this for the face-to-facers and for you folks at home. I'm going to show the answers real quick. You're probably not done, so what I want you to do is have a separate sheet of paper and jot these down real quick. Okay? Now go ahead and show the Elmo, but I'm going to keep talking. Okay? Go ahead and show the Elmo, but I'm going to keep talking. Okay? Now don't just copy these down on the worksheet itself. I want you guys to work through these and do them. But I want you to have the answers so that you can check them when you are done, okay? So just write these down on a separate sheet of paper. And then I want you to complete these 3 worksheets as part of your homework. Not all your homework, but part of your homework. Okay? So those are the answers to the first, that's to the first worksheet. Okay? Now we'll walk through these in more depth next class period. All right? Let me show you the answers to the next one. Right now, just copy the answers down. And I pray I haven't made a mistake, because I just did it real quick myself. All right. We'll talk through the hows and whys and all that at the beginning of next class period. But I want you to have the answers, okay? So write quickly. Okay? The answers to the last one, the accrued revenues. Whoops, I forgot to put a little yellow. That's the answers to the third worksheet. So, I hope you wrote those on a separate sheet of paper. Okay? We'll go through those next time. But let me write down your homework assignment. Okay? Let me write down your complete homework assignment. Hope you guys are doing your homework. You guys will not and cannot learn this stuff just by watching me do it. You've got to learn it. You've got to learn it by doing it, okay? So, let me tell you your complete homework. Finish the 3 handouts that I gave you, okay? Then I also want you to do quick study 3.2 and 3.3. I want you to do exercise 3.5. And then I want you to do exercise 3.4, but I only want you to do C. Okay? Exercise 3.4, C only. Okay? So that is your entire homework. Finish those 3 handouts. Do quick study 3.2 and 3.3. Do exercise 3.5 and then do exercise 3.4C. And do them in that order. That's why I give them in that order, okay? All right, folks, you guys are doing good. Let's see you later. Bye-bye.